Happy New Year. Hello and welcome to Canvas the Niger-Delta Roundtable, where I discuss the future of this region blessed humongously with hydrocarbon resources. Every week, we give time to reflecting on topics relevant to the development of the Niger-Delta and her people. This episode is no different. We're here once again to focus on how to take the region to a more promising future. And the program is sponsored by the operator of the NNPC SPDC, the Total Energies Achievable joint venture, the Shell Petroleum Development Company of Nigeria Limited, headquartered in Port Harcourt. Many thanks for joining. I'm Temidayo, Shakin. Our topic, the first for this year, is getting your finances right in the new year. It is a new year, and there are possibly several things you need to get right. One very important one, no doubt, is your finances. Once again, welcome to the first edition of the podcast for the year. I'm thrilled to have you join us for the very first episode of the new year. And as we step into the new year, it is the perfect time to take control of our finances and set ourselves up for success. The start of a new year brings a sense of renewal and opportunity, making it an ideal moment to reassess our financial goals and strategies. In today's episode, we are going to explore practical tips and strategies to help you get your finances in order. Whether you are aiming to save more, or pay off a debt, or start investing, we have you covered. We will discuss how to create a realistic budget, build an emergency fund, and set achievable financial goals. Plus, we will dive into the importance of credit scores, the benefits of automating your savings, and smart ways to tackle high-interest debt. Well, that is not all. We'll also touch on the significance of regular financial reviews and how to adjust your plans to life changes. And by the end of this episode, you will have a clear roadmap to financial stability and success in this new year. So if you will, grab a pen, a paper maybe, and let's get started on making this new year your best financial year yet. Remember, taking small, consistent steps can lead to substantial changes over time. Let's embark on this journey together and make this year a financial empowerment and growth year for you. Now again, a topic on Canvas for this episode is getting your finances right in the new year. My guest is Dr. Eniola Yemi Temidayo. Dr. Temidayo is a seasoned innovation and enterprise development consultant, award-winning entrepreneurship educator, innovator with registered copyright and patents with several business books to his credit. The most sought after being that on the building of sustainable business models. His work experience covers Nigeria's publishing, finance, logistics, oil and gas, healthcare, hospitality, agriculture, mining, and civil construction industries. Dr. Temidayo, Happy New Year to you and welcome to Canvas and Niger-Delta Roundtable.
Happy New Year, Dayo, and Happy New Year to the listeners. Thank you for the opportunity for inviting me.
When I thought of someone to have this conversation with, I reached, as I mentioned to before we started recording, I reached into my database and your name kept popping up. Assuming my mind was some kind of a computer, which I think it is actually.
Thank you for your kind words.
And I have no doubts that we're going to have a very insightful and practical conversation.
We would.
Let's start on this note. What is it about the new year, or any new year, or a new year, and setting targets? What is it? Because the start of every year, you have conversations about setting targets, about setting goals. Why does that seem to be a thing?
Well, when you look at, when it's first of January every year, one of the things that comes to your mind as an individual is what did I achieve in the previous year? What did I not achieve? What could I have done differently in the previous year? And what should I be doing in this year? Because every new year comes with its own baggage. There are opportunities and there are threats that basically come to you as an individual or to your business. So you want to ask yourself, what should I be doing now so that at the end of the year, I'll have a different report card for myself. So it's important that we don't just start a year and just expect things to just go like that. We need to sit down and say, look, what do I want to achieve? So that when you set those targets for yourself or you set those goals for yourself, then every step you take, everything you do will be intentional. And it's important that we're intentional in everything we do if we want to actually see the differences that we want.
Speaking of intentionality, getting your finances right, I perceive, is a very intentional thing.
It's the most intentional thing that you need to engage in.
It doesn't just happen.
No, it doesn't. It's not something that you wish. You don't sit down and wish and say, by the end of this year, I should have 20 million in my account. No, you can't wish it. You have to be intentional about it.
Sometimes, just a slight digression, I see some of the content producers on social media who make skit and comedic material, and you find maybe two persons they're usually two guys depicted having a conversation, and maybe they're high on something. I want to say something like, I wish as I'm walking on the road now, I just see 100 million. And then I start saying, I will spend 20 million. It doesn't happen that way in real life.
It doesn't happen. It can never even happen. It doesn't, how would somebody just throw 1 million naira on the floor? 1 million naira is a lot of money. So I think that people need to really move away from that mindset where you just think that you're going to live your life based on people giving you gifts or you just come in contact with sudden wealth. It doesn't really happen that way. You need to be prepared because there's so many opportunities around us that people are not seeing. And then until your eyes are open to those opportunities, then they'll just be passing you and you think things are difficult. But, the truth is that in every difficult situation, opportunity, people are making money. And so people need to learn to tap those opportunities. So you just have to be intentional if you want to make any changes in your life in the new year.
It is a new year once again.
Yes.
And talking about getting your finances right in this new year, or any other new year for that matter, but especially this one, because we have this one right now.
Yes.
And if there ever was a time appropriate to get something done, it is now.
It is now.
What are the first steps a person needs to take to get their finances right in a new year?
First, I would say that when you look at the issue of finances, a lot of people think that you need to have so much to be able to plan your finances. But the truth is that it depends on how your mind works. Are you telling yourself some hard truths, or are you telling yourself that things will just change when the reality before you does not depict that there's going to be any positive change? So it's important that you sit down and ask yourself, how do I want my finances to be this year? And then the first thing you need to ask yourself is, what do I earn? Or the income that I got last year, how much was it? Were there opportunities for me to have made more money that I didn't take advantage of? Or did I just sit down and I was waiting for things to change and then I will make money? Because a lot of people are waiting for changes to occur, then they can tap in. And then anybody who is going to make any difference in this new year has to be proactive. You're not going to be reactive. Because when you're reactive, a lot of people will be pushing that same opportunity with you. But when you are proactive, you envisage that change happening and you're getting yourself prepared. And once you are prepared for that change, then you can tap into those opportunities. So financial stability is about being prepared, getting ready, being intentional about opportunities that will come and you tapping into it. So it's important that if you are going to be financially stable, and the issue of stability is another thing, because your stability may not be my stability. For somebody, stability may mean him having 200 million. For somebody, just having 2 million or 1 million in his account at the end of the year is stability, because their level of expenditure differs.
So what does it mean to be financially stable?
To be financially stable primarily means that you are positioning yourself in such a way that what you earn is enough to keep you going, to give you the standard of living that you want. Not another person's standard of living, but your own standard of living. For somebody, it may be, look, I just want to be able to eat 3 square meals in a day. I want my children to be able to go to school and come back. For somebody, financial stability will mean, he's able to, beyond eating those 3 days, every week he's able to go out somewhere and hang out. So if I earn enough to be able to live the kind of standard of life I want, and I'm able to save so that if there's any challenge, I can meet my needs. I'm stable. So there's somebody who may be earning 10 times what you are earning, but at the end of each year, the person is still in debt. So you cannot be financially stable if at the end of the year, you find out that you are in debt. So financial sustainability, financial stability requires that at the end of each year, you are debt-free. You are debt-free. So that at any time you need a particular sum of money to meet a need, you have it. So somebody may be earning 2 million every month, and at the end of each month, he's still in debt. And there's somebody who's earning 500,000 every month. At the end of each month, he has the savings. So the man who is able to have that saving is somebody who is financially stable.
All right. So you described two different sets of persons hypothetically.
Yes.
In explanation to financial stability just now. So for one person, the goal is I can feed myself and my family comfortable. My kids can go to good schools. And some other person is besides that, I want to be able to hang out every now and then.
Yes, go for
fine
holidays
dining,
and all of that. Yes.
Holidays and all of that.
Yes.
Now, for the person who is in category A, feed my family, good schools, and that's it. Would it be wrong for the person to aspire for fine dining and holidays as well?
No, it's not be wrong. Of course, your goals this year, your financial goals this year will differ in the next year. This individual now say, look, okay, in the next 4 years, I know that my kids will all have graduated and they'll be working. So after they start working, am I supposed to be taking care of them? That's the question the person will need to ask. If the person says no, then at that point in time, there's money for you because your kids now are out of the equation. So you, yourself and your wife now, or yourself and your husband now are the only ones staying. So your goals will change. The definition of financial stability will change for you. It will no more be, I'm taking care of my kids because your kids are out of the way. So those dreams that you've had, I want to be traveling, now that's the time for you to begin to travel. But you see, a lot of people mix everything up. They want to be able to meet those goals of taking care of their kids and also on holiday. And at the end of the day, they don't have any savings at the end of the year. At the end of the day, they're in debts. And most times, it is because they are running with somebody else's financial stability status.
But somebody else is doing that. Why can't they do that?
Because they don't earn the same amount of money, or their spending patterns are not the same.
Speaking of goals, how important is it to set financial goals at the start of the year? And what examples of effective financial goals a person can set?
Okay, let's look at first, what are the goals that you can set? And then let's see how those goals can affect your life. Now, when you come into the year, like I said from the beginning, the new year is the first day of the new year is an opportunity for you to reflect on what had happened in the previous year. Unfortunately, many people, the first 1 week of the new year is used for celebration. They totally forget.
Is that such a bad thing?
For me, I think that there should be a paradigm shift. If that's what you used to do, you need to change. Because you see, the first 1 week shouldn't be all about celebration. I'm not saying don't celebrate, but have a time to withdraw and ask yourself, what did I achieve? Because most time you will not do that till the 31st. So you're entering the new year. For some people, they probably will do that before the new year. But if you have not done that before the new year, this first week of the new year, take out time and ask yourself, what is it that I wanted to achieve in the previous year financially that I didn't achieve? And then what didn't I do right? I mean, you need to ask yourself some questions. How did I spend my money? And most time people don't also have a record of their expenditures. They don't reflect on how they have spent their money. Someone does say, look, I earned so much, but I don't know where the money went to. A lot of people have that kind of experiences. And then sometimes when you now sit down, you now begin to see that, I spent so much on this. I gave out so much gifts to this. I'm not saying don't give out gifts, but don't give out gifts in such a way that at the end of the year, you don't have any savings. Because those people you have given gifts out to, most of them may not be able to help you because they were in need. That's why you helped them. So, and if those people who are supposed to help you know that you have been giving out gifts to people like that, the question they will ask is, this guy is not financially prudent. He's just giving out gifts. And you may have done this out of artistic value or, values, but they will not see it that way. So it's important that your good is not seen as evil. especially when it comes to finances. So I usually will encourage people that you must have a savings that, irrespective of what people around you are going through, you don't touch that money. It looks difficult, it looks hard, it looks sadistic sometimes, but no, it is about financial responsibility. It's about being disciplined. And so it's important that you don't just spend everything. So like I said, so you must be able to sit down in that first week of this new year and ask yourself, what is it that I want to do? And for me, one of the primary things I think that everybody should tell his or herself is, I want to end this new year without debts. That should be the primary goal. I don't want to owe anybody at the end of the year. And because you see, when you're not owing anybody, you will sleep. You'll be at rest. In fact, sometimes you will eat gari and come out of your house with toothpick and people will think you've eaten meat. But they don't know that you have just drank only gari. But because you're not owing anybody, nobody's going to ask you what you ate and what you did not eat. But if you are owing people and you come out to the street with toothpick, the guy will ask, oh, so you've been eating meat and you are owing me. So it's important that you tell yourself that this year I don't want to be in debt. And so whatever you need to do not to be in debt, you need to do it. Sometimes it may even require you changing the school to attend so that you are not in debt, so that your kids are not sent home because you cannot pay the fee. And I think that's one thing that a lot of families need to really watch. A lot of families are spending a major part of their income in schools, just trying to impress other people. And then some of those schools that these kids go to, at the end of the day, you discover that you're even the one doing the work because they load your children with so much assignments. The children come back weekends, and your weekends are totally tied to helping them to answer those assignments. So you need to watch all of this.
That's such a terrible thing because there are folks, I imagine quite a number, who would say, I mean, come on, Nigeria is owing. There are countries that are, the most developed country in the world, supposedly the US, possibly I think has the largest debt as well. Dangote is owing. Adinuga is owing. Otedola is owing.
Yes.
Billionaires are owing. Countries are owing.
Yes.
Some of the most thriving economies in the world also thrive on the credit system.
Yes.
Once again, the US, for example, people buy things on credit. They are amassing debt. So what's wrong with me owing?
Okay, what's wrong with you owing? You see, the systems, the various systems that you have mentioned, countries where the credit system works, the individuals who live in those countries and who are in debt are also not finding it funny. And one thing again you need to realize that those countries also have insurance against those debts for those companies that are giving you those debts. If you are not able to pay, you can go and declare bankruptcy. And then after a certain number of years, your bankruptcy, you can approach the court again, and then you are declared free from that, your bankruptcy judgment, and then your life starts all over again. People can take advantage of that, but we don't have that in Nigeria. So our environment is unique. The truth is, if you owe now and you're not able to pay, the next time you ask people to loan you money, they will not. So if you tell your friend now to give you 20,000 and he gives you 20,000 and you tell him I will pay you back in 1 week, and 1 week comes, you start telling him a story, 2 weeks, then suddenly he decides to forget and not ask you again. He will not ask you for that money, but the next time you are coming for money, your credit is not good with him. So once you start telling him, can I have, and you probably will even need that money urgently, but he knows that you don't have the history of paying back. So what will he do? He will not pay. He will not give you that money. And when people say, oh, people like Dangote are owing, Dangote has an individual is not owing. It is his business that is owing. And you see, in owing that, in collecting that loan from banks and all of that, calculations have been done that the business that are going to invest that money in is going to be able to pay back that debt. Not now, but in the future. There's a timeline for the repayment of that debt. So for you as an individual, when we talk about your personal finances, you should avoid owing. I'm talking about your personal finances. If you are borrowing to put in a business, now it is not you that is owing, that business that is owing. You should be able to have that managerial skill to be able to ensure that that debt that your business is owing, that your business is able to pay back so that you can keep getting access to funds anytime you need funds.
Earlier on, when you talked about not owing, you also mentioned at the end of the year, you should be able to have savings.
Yes.
Something that, in case you have an emergency or situation you have to deal with, you can attend to it. What is the, can you explain the concept of an emergency fund and why it's crucial for financial stability?
Let me use the local palace. When people talk about emergency fund, they say vex money. You know what people say, vex money? Say if anything happen at all, and I'm at a crossroad, at least this one should be able to see me through. If, for instance, you are traveling to the village to go and see someone, you are traveling to town to go and see somebody, you say, let me hold vex money in case I reach there. And what I was expecting I don't see it, and I need to come back. At least I will have transport money to come back. That's a simple example of what an emergency fund is. You are not saving that money for investment purposes. You are putting that money aside to say, look, in case I need to have the need for money, I don't have to rush and go somewhere. That money will be there. Sometimes that emergency fund may be in your house. It may not be in the bank, because that's why it's called emergency fund. You should be able to have access to it when you need it. But if you go and put that account emergency fund, and I need to be careful to also say that when you have those kind of emergency fund and you're keeping them in your home, it should not be something that everybody knows, so that your house does not become a target for robbers. But you should be able to have some money somewhere, that your vex money should be something that is handy. But in the larger definition of emergency funds are money you put aside to be able to have access to when things that you have not planned for come into play. Now, when people talk about in case you are sick or a member of your family is sick, I don't think that should be an emergency fund. There are insurance policies that you can take to take care of that, so that when any member of your family is sick, you can have access to it. There are a lot of things programs and policies that are in place that we seem to just overlook as individuals, because we think that we will never be sick. So when they tell you, do health insurance and pay a certain premium, people think that premium you are doing is a waste of money, but actually it's another savings. At least for that year, it's a savings for you against when any member of your family becomes sick. So you can go to the hospital and access health services for little or nothing under those insurance policies. So these are savings that people also ignore and don't take advantage of. Your pension scheme and all that, you should take advantage of those, but those are not emergency funds. Emergency funds are the monies you keep aside for those things that you don't plan for. You should plan for your health care. I think that people should plan for their health care by paying premiums.
What are some common mistakes, common budgeting mistakes that people make, and how can these be avoided?
If I go back to the example you were making about skits, where somebody's talking about picking money on the ground and all of that, 50 million. Most people actually don't sit down to plan their budgets very well. And when they sit down to plan the budget, a lot of them do it on assumption. There are people who are gamblers, who are serial gamblers. They are like, okay, this year now, if I win so Nigeria bet on this debate, you see, that's an assumption that may or may not happen. So budgets are not supposed to be what you plan. You base your plan on what you think may or may not happen without information, because budgets are estimations that you make. I'm estimating that I'll make so much money this year. Now, if I tell myself I'm going to be making 100 million this year, I should not just write it 100 million. I should have realistic plans of how I'm going to make that 100 million. Where am I today? Do I have up to 50 million? Okay, so my plan is that in this year, I'm going to double it. So in my budget, I'm going to have 50 million. What are the ways I'm going to use to make those 50 million? For some people who like to be very spiritual and think that God is a magician, they probably say, okay, if I sow half of it in the church or in the mosque or in one religious organization, one charity thing, it will come back. It may not come back, but of course, those charities will not give it to you It's opportunities that will come to you. So the issue is, when I give this, what are the opportunities I'm expecting to come my way that I will tap and make the money? So in your budgeting, everything that, especially the income part, you see, the expenditure part is easy to spend money when you have it. Is to make it that. So the most important part of your expenses is the income. A lot of people seem to focus more on what I want to do. Oh, I will send my kids to this school. I will travel. I will buy this. I will change my car. I will do all of that. That's the expenditure part. It's easy to really write that. It is matching that expenditure part with the income part, the part of how will I make the money. So a lot of time, our budgets are driven by what we want to do, not by what we are expecting to get. So let our budgets be focused on, plan your budget on what you are expecting to come in. So if you know that you are expecting some amount to come in, by the time you are doing your expense part of the budget, because you know that this is how much is coming, you'll be forced to have a scale of preference in preparing your budget. So a lot of people don't have scale of preferences because they just think that the inflows that will come will be endless. So they just put all their expenditures on the right side, and then they're thinking about how do we knock them off. No, first think about how you get your money.
I think one of the examples you gave earlier on, you referenced credit scores when
Yes.
you give the analogy of somebody who borrows money from a friend
Yes.
and doesn't pay back as at when due. Why is it important to maintain a good credit
scores,
score, and how can individuals improve their credit scores?
Okay.
And you could start by explaining the concept of
credit score.
Credit score.
Okay. We don't do too much of credit score in Nigeria. In climes where credit score happens, if I go and borrow money from the bank, let's say I borrow 10 million, and I'm supposed to pay, and I pay as at when due, and at the end of the year I knock off my debt with the bank. If I'm going back to them the next year, now because I have been faithful in paying my debt this year, when I go next year, instead of taking 10 million, if I ask them for 20 million, they probably will give to me, because my record shows that when I take money, I pay back. Then they will not. That's not just that. The bank I'm also going to will look at what is my savings. I've been saving money and I've been spending. So sometimes they will also look at your expenditures, because your when you're using your credit card and all of that, your expenditure shows where you are spending your money. So if in a year, let's assume in a year, I have made 20 million, and then my expenses shows that out of that 20 million, 25% was spent in a lounge. 25% of my money was spent in the lounge from the calculation. So when they do a proper analysis, they say, okay, this guy spends 25% of his money enjoying himself. Are you saying? So for so many things, that is interesting. That pattern is interesting to so many people, those who are in data analytics. So they say, okay, this guy is the guy who likes enjoyment. So those guys who provide services for people who like enjoyment, they will begin to target you so that they can eat out of that your 25%. But for the bank is like, okay, so if we borrow this guy 100 million, probably 25 million out of that 100 million will go towards enjoyment. So it becomes something that, evaluating you personally to give you loans, it may not speak well for them. It may not speak well for you. I mean, they may be scared about giving you that money. So all of these factors combine, and so many other factors combine to say, okay, this man is somebody that can be given money, and we know he will pay back. So your credit score actually shows your credibility and shows how much credit you can get, or how much credit, if you're given to you, you'll be able to repay back. So bring it down. Let's bring it out to the layman. If I have friends and I meet my friends and I tell them, give me 10,000, give me 20,000, give me 100,000, give me 150, 200, and I'll pay you. And every one of them that I borrow from, I pay them. Now, when these guys are meeting privately without me talking, and then the issue of borrowing comes, this is the guy they borrow, but they pay. So before them, this is somebody that if you give your money to, if you give him any amount, and he tells you he will pay back, he will pay back. So with them, your credit is good. So it helps you because anytime, in fact, if you have those kind of friends that when you call money, you pay them, they may be your own source of emergency fund. You may not need to put money down because you know that you can reach out to them and they will give to you, and they will give to you because they know that you pay back. So your ability to pay back is primarily what defines your credit score, your credit value.
It is Canvas in Niger-Delta Roundtable, a first episode of the podcast for the year. Happy New Year once again. For this episode, we're discussing getting your finances right in a new year. My guest is Dr. Eniola Yemi Temidayo. We go for a break. We'll return in a moment. The conversation will continue. Do please stay with us.
Yellow and black markers indicate pipeline and flow line right-of-way boundaries. Your activity could impact on the buried high-pressure hydrocarbon pipelines and flow lines, leading to possible leaks and explosion. Please keep off. Do not engage in sand mining or any form of excavation, pipeline vandalism, oil theft, and bush burning within pipeline and flow line right-of-way. Do not farm, trade, or locate any business on pipeline and flow line right-of-way. It is against the law to apportion land, sell, or build on pipeline and flow line right-of-way. Maintain a setback distance of at least 30 meters or about 100 feet from the right-of-way boundaries always. We care for your safety and that of the environment.
This message is brought to you by the Shell Petroleum Development Company of Nigeria Limited, SPDC, operator of the Nigerian National Petroleum Company, NNPC Limited, Total Energies, and Ajib Joint Venture.
Welcome back. Still Canvas, the Niger-Delta Roundtable. Happy New Year once again, and thank you for joining us in this very first episode of the podcast for the new year. I'm Dai. My guest once again is Dr. Eniola Yemi Temidayo. Doctor, welcome once again.
Thank you.
We're discussing an ultra important matter, one that you have to be intentional with, to borrow the expression of my guest just a while ago. Getting your finances right in a new year. It is a new year, and if there ever was a time to get your finances right, it is now, especially now that it's a new year. And one of a very significant thing I got, Doc, in the first half of our conversation is if there is one goal that you must set for this year, it is by the end of the year, you are absolutely, totally debt-free.
Mm-hmm.
Very important. I hope you caught that, by the way.
Yes.
All right, moving on. Taking loans is still, at some point you may have to, even you described that a while ago, you may have to reach out to a friend or some acquaintance to take a personal loan,
Yes.
or maybe even for a business for that matter, or for a business venture or investment you want to make, you may have to take out a loan at some point. Now, a two-pronged question here. First, is it advisable to take loans in the first place? And then second, taking loans in Nigeria can be a very daunting task, especially if you're approaching financial institutions. Interest rate in Nigeria quite high, possibly some of the highest in the world, or one of the highest in the world. What strategies would you recommend? It's the second part of the question now. What strategies would you recommend for paying off high interest debts efficiently?
Okay, first you asked the question, you said, is taking loans, is it good? My answer will be, it depends. If you are taking loans for a business, it is assumed that you have done your calculation and you know that the loans you are going to be taking, that whatever cost or the interest that is going to accrue from it, that business will be able to pay it back. So if you are taking a loan for the purpose of investing in business, which means that there will be a return, it's good. Now, but if you are taking a loan at interest to meet a personal need, which is not going to say yield any returns for you. For instance, should I take a loan to send my children to school? Some will tell you, oh, it will yield interest in the future. How is the interest going to come? That when my kids when they finish school, they will take care of me. Who guarantees you that? What's the guarantee that you will not even die before your kids start making money? So I think that we need to be intentional when it comes about taking loans. You need to ask yourself, why am I taking this loan? And then, so if I'm going to be taking a loan to meet some personal need, I should be able to look elsewhere, look where I will not pay interest on it. You know, in raising funds, usually we say you can use your own assets to raise the funds that you need. If I have a car, I can sell my car and raise money from it to attend to some needs. I can approach families, I can approach friends. Now, when I approach families and friends, there are some friends who will want me to pay something back besides the sum and the capital. Now, there are others who are ready to give me funds that I don't need to pay back. And I can use this for different reasons. I can use it for my personal needs, I can use it for my business. So you need to be able to assess based on the relationship you have, where you can get loans from, because it's not all loans that come with interest. So so if I can go to a place where I will not be paying interest, why not? I'll take advantage of that. But for as long as I know I'm going to be able to pay back. But for businesses, if you are going to be taking a loan, you also need to be very sure that you're going to be making a margin that would exceed the interest you are paying. If it is not going to exceed that interest, then of course you need to step back and forget that loan. Don't just take loan for the sake of taking loans. And some people take loan just to keep the business going, even though they know that the business will not be able to generate enough returns to take care of that loan. I mean, that's bad financial decision taking. So it's important that you take the right financial decision. Don't take loans that you will not be able to pay back. Now, when you say an interest loan is the interest on the loan is high, it is high, but when you went to apply for the loan, you did do your calculations very well. Now, I understand that some people take loans and they tell you in the clause the loans will be subject to changes it will also be subject to any change in interest rates and all of that. So it's also good that you have negotiation skills so that when you are taking a loan from an institution, I mean, you don't just sign dotted lines, you don't just sign your life away. There are a lot of people who sign their life away because they're desperate to get that money. Then when the reality dawns on them, they now begin to start complaining, but you're the one that signed the dotted line and said, I will do this, I will do this. So whatever interest rate you have committed yourself to paying, you should be intentional about paying back. But the beauty is that when you take loans from the banks and that you are not able to pay, usually the banks will at least want to recover the money, the capital they give to you, so that everything doesn't just go down. Because, I mean, if it becomes a bad debt, they're the ones that we eventually lose. So they are usually open for you to come back and have a discussion, and then they renegotiate the interest rate, they spread out the payment plan for you and make sure that at least they get their capital. Once they get their capital, then is the interest factor now that we're thinking about. There's a tendency for them to bend the rules or shift ground and make it easier for you to liquidate your debt. So it's important that you don't run away from paying your debts. Once you find out that it's getting difficult for you to do that, just go back to the bank, go back to the people that you have borrowed money from, and sit down and say, look, this is the situation I found myself. I'm finding it difficult to pay. Can we renegotiate the terms? Can we spread it out? Can you make it easier for me to be able to do this? Because if you are making all the money and all the money is just being taken, then you get to a point where you won't have working capital to continue the business. So it will be a lose-lose situation for everybody. So it's important that you sit down to renegotiate those interest rates.
I've heard the word automation
Yes.
come up frequently, especially by experts, so to speak, or those who supposedly know about financial management.
Yes.
Automation has been described as one way to effectively manage one's finances. What exactly does it imply, and how can one use automation or or apps or tools or things like that to effectively manage one's finances?
Okay, when we use the term automation, it doesn't necessarily mean the application of technology in the process. It just simply means that you put in place a system, a process that ensures that a particular thing you want done regarding your finances is done. For instance, if I earn a certain amount of money and I want 20% of it to go to a particular savings account, so I can go to the bank and say, look, banks, when anytime my salary comes in, this is a standing order. So I give them a standing order. I want so amount to go here, so amount to go here, so amount to go here. So I give the bank a standing order. So I don't need to be calling the bank every day. Once any funds come into my account, I can say, look, every income, every inflow that comes into my account, every money that comes into my account, share it this way. Now, that presumes that every money that is coming there is an income that I want distributed. So once that money comes in, based on that, so the bank, what the bank does is the bank that we put that loop on your account based on the instruction you are given to them. Once that money comes in, that is what that amount will go to that particular account. So you can also put another further lien on that account and say, look, once my savings in this particular account hits this figure, I want you to invest this amount in investment. Put in this investment for me, and then there was a question you asked about possible investments. One of the things that I have seen that a lot of Nigerians are not taking advantage of is the treasury bills.
Have we got to that yet? The issue of investments?
Yes, you were talking about how we can ensure we get money.
Okay, I'm not sure we got to that yet.
Oh, okay.
Okay. All right, but go ahead. Go ahead.
Like I said, one investment I think that a lot of Nigerians are not taking advantage of is treasury bills. The interest rate on treasury bills are very interesting. And I don't want people to fool other people and say, look, inflationary rates and all of that. Now, inflationary rates will be there, yes. But you see, that money you are putting in treasury bills, the truth is why you're putting in treasury bills because you don't have one investment you want to put it in. So instead of it just lying down in your bank and thus not giving you the kind of profit you want, I go and put my treasury bill at 21%. And I get my interest up front. So I have that money that I can use to do so many things. So I think that people should learn to be able to spread their risks.
Let's talk about investing. What are the benefits of investments? And how should someone new to investing even start at all? For someone who's heard about investment, how to invest and all of that, why should I invest my money? And how do I even go about it?
For people to invest, the first question you need to ask yourself is, what am I investing in? Or primarily, what is even investment? What is investment? Is it that, because when you talk about investment, a lot of people think about cryptocurrency, you're going to put the money in cryptocurrency. Some people think about Forex and all of that. Let me go and put my money in one Forex place and then they give me 2%. Now, these are all investments, but time and time again, we have discovered that a lot of people have their fingers burnt in that investment in Nigeria, and speaking specifically in Nigeria now. So first, when we say we are investing is that we want to put our money somewhere so that we can get a specific return, a desired return. So for me, I may be satisfied with those 5%. Somebody else may be looking for 20%. Now, somebody else may even be looking for 40% return on whatever he or she puts her money. So it's important that if you want to go into investment as an investor, you need to ask yourself, what is the minimum I can take? What is the minimum return I want? And then what is the risk associated with that investment? Because most time people are carried away by the returns, but the risk, that's the possibility of losing my money in that particular investment. A lot of people don't look at that side of it. And that's where a lot of people have their fingers burnt, because when they get carried away by the percentage they'll be giving, they put their money, and then the individuals who have promised them that percentage suddenly discover that they cannot deliver. And one reason why they cannot deliver is usually when the interest rates is high for investments that are not risk-free, that are not guaranteed, people will want to come there and put their money. And then at the end of the day, the person who is collecting that money to invest discover that he or she has a lot of money in his or her hand that he cannot even invest. So you get to a situation where we could say the person is over trading. That is, you are collecting more than you can turn around. And so it becomes difficult for you to meet the promises you have made to everybody. But when you want to start investing, my recommendation is look for risk-free investments. And one of the risk-free investments are government bonds. They may not be very fantastic in terms of interest rate, even though right now I can tell you that 21% on treasury bills is an interesting interest rate that people should take advantage of. So I expect that learn to put your money first in treasury bills, because that is guaranteed. Your money will be returned to you. The bank stands like guarantors for you because you are investing through your banks. Once it's time for your money to come, the day that your bonds mature, you get your money straight credited into your account. Of course, the bank take a little percentage of the interest due to you for helping you to house that investment. So you can start that way while you take your time to look at other opportunities that exist. I think that for you to invest, you should seek advice of people who are in that field, not just throw your money. But like one of the things I always tell people is that the best investment is actually identifying a business that you can do. That you are directly involved in managing your funds, not somebody else managing it for you.
No, so the year started. I've made plans. I've done budgeting. I've set money aside. I have my emergency fund. Yes. Maybe I'm even investing in some kind of business. After watching this podcast, everything is set.
Yes.
This year ending, I'm not going to earn anyone. As a matter of fact, I'm going to have a surplus, if you will.
In my account.
Exactly. Now, do I have to periodically review my financial plan? And if I have to, how frequently do I have to do that? And what exactly am I looking out for when conducting this review?
Okay, at the beginning we talked about what financial goals can somebody set. One I said is you can set a goal of say at the end of this year I want to be debt free. That is one. Now at the beginning of the year I can tell myself, look, I want to save. My goal will be this year I will save 20% of all my earnings, not just my salary, all my earnings. I will save 20%. On that goal will be, look, at the end of this year I want to be able to have an investment portfolio that is worth X amount. So these are various goals that you can set for yourself at the beginning of the year. So do I wait to the end of the year before I do an evaluation of these goals? No. At the beginning, each month, just tell yourself, because in your savings pattern, you are saying, I want to save 20% every month. So at the end of each month, you should be able to ask yourself, have I saved 20%? If yes, I tick it. Then, of course, and when you evaluate that, there's something you ask yourself, I have saved 20% in a savings account, but in this current account that receives all my income, I still seem to have surplus that I've not invested. And it's just lying there. Should I do something about this money? So at the end of each month, you suddenly discover that you probably should be able to do more. So now, don't forget at the beginning, you said you will save 20%. So at the end of the first month, you may now change the rule and say, look, I need to be able to save a minimum. So, at the beginning of the year, your ceiling was 20. Now you're saying, I should be able to save at least a minimum. So if at the end of the month, I do an evaluation and score that I still have excess, then I tell myself, okay, am I going to wait till the end of this month to the second month to increase it? I can just immediately, at that point of evaluation, I can immediately carry another sum, which may be 10% again, and add to what I have saved. Don't forget that the target is that I want to have a minimum of 20% of my savings, my income as savings at the end of the year. Because the more savings you have, the better for you. And I can decide and say, look, instead of putting that 20 in savings, instead of putting that extra in savings, I probably will move it to my investment account, or I can move it to my emergency funds account. So So the essence of evaluating at the end of each month is to be sure that you met your target. And if you did not meet your target, why did I not meet my target? And then you now put in place a measure to ensure that in the coming month, I do something. So if at the end of this month I discovered that I was only able to save 15%, then I know that in this second month, I need to increase it from 25 to what? To 20 to 25%, so that I make up for that 5%.
Speaking of that, somebody who is struggling to, and that's incidentally takes us to my next question.
Yes.
For a person, in spite of having the budget and having planned at the start of the year, but who is still having struggling with making savings, especially one that they are committed themselves to, or even sometimes making any savings at all, what advice do you have for that person?
First is to analyze why am I not able to meet those savings target I've given to myself. You need to sit down and evaluate. And most times we will discover that the reason why we are not meeting up is because we probably the target we set for ourselves was higher than we could achieve. Because for any goal to be an ideal goal, one of the things that must be realistic, it must be achievable. Sometimes it may not be achievable. And if you want to make it achievable, it means that your standard of living will probably go down. So if you told yourself, look, I'm going to be saving 20,000, then you now discover that you're only able to save 15,000 every month. Now, and you are now saying, look, I must make sure it's 20. So there are two ways you can raise that extra 5,000. It's either you are earning more money or that you are reducing your standard of living to be able to get that money. So, and there's a danger in trying to reduce your standard of living because it may mean that you'll be missing one meal. And that's probably be something that will affect your health. So what you do is that you sit back and say, look, I have discovered that it's difficult for me to meet this standard of, this goal of 20,000. I can meet 15,000. So you just review it. I mean, these goals are what you have set for yourself and they're open to reviews. Because once they become unrealistic, for you to say you want to pursue something that's unrealistic, you are actually setting up yourself for frustration.
I think we've come to the end of this episode. But before we do, one final question. Do you have a call to action? Final words.
My call to action for everybody listening is that in this new year, don't spend your money looking at somebody else's expenditure. Life is not about competition. It's about what you are able to do for yourself. And I will encourage that you should set standards for yourself. Don't use somebody else's standard for yourself. You set your own goals and your own standards and pursue that, especially your financial goals. Don't put yourself in a situation where you are competing with somebody else. You guys might be earning the same salary, but you see, he or she may be earning or getting some money from something else, from another source that you don't know. So the fact that the person bought this does not mean that you should buy that. The fact that the person went on holiday does not mean that you too should go on holiday. Just focus. And I mean, just do what is best for you and not best for what other people think for you.
And that's it for this very first episode of Canvas the Niger-Delta Roundtable, our podcast brought to you by SPDC for the brand new year. Thank you very much for being a part of it. We've discussed getting your finances right in the new year. My guest has been Dr. Eniola Yemi Temidayo. Doc, it's been a pleasure having you here.
Thank you, Dayo. Thank you for inviting me.
I remember, like my guest mentioned, you have to be very intentional in managing your finances. Wishful thinking doesn't make it happen. Intentionality is the key here. I'm Adedayo Olusegun. Wish you the very best. And I hope that by the end of this year, when you look at your bank account, you're going to smile. And very important, you owe no one anything. Have a great day and have a wonderful year ahead. Bye for now.